Hello, everyone, and welcome to the iSectors Market Review for the fourth quarter of 2023. I'm your host, John Koch, Senior Investment Analyst at iSectors, and I'm joined, as always, by the CEO and CIO of iSectors, Vern Sumnicht. In this short video, we'll walk through a brief outlook on our current views of the economy and what our research is telling us about the market going forward into the rest of 2024, along with some exciting developments in one of our more niche models. We will also briefly touch on fourth quarter performance of all the iSectors models and highlight a change we made early this year in our equity portfolios. As a reminder, if there's anything we don't touch on today, you can always view full performance data and written commentary on our website or reach out to us directly to schedule a one-on-one review of this material. Without further ado, let's dive in. I'll hand it over to Vern to start with a discussion about our post-MPT allocations and how they shape our current economic outlook.
Thanks, John. It's kind of fun to be able to talk about such a good quarter that across the board, I think. It's always more fun to talk to clients about great performance than it is about difficult performance. So it's been a good year and a good quarter. I just point out that a couple of highlights and then turn it back over to John in respect of everybody's time. So we've seen a lot of very stable economic numbers over the last quarter. And like unemployment has remained below 4%. Inflation's remained below 4% for quite a while now. I think we're down to about 3.3. And interest rates have been low and falling a little, which is good for the markets. Tech, gold bullion, and healthcare have held the largest weightings over the last, certainly over the last quarter, a little bit longer. And you can see below in our analysis of the allocation history that both post-MPT and growth and moderate have maintained pretty stable and been the highest allocations in both of our models really since September, and remained so in January. And you can look at this if anybody has any questions. As John said, contact us. Be happy to discuss it further. Other points. John, you want to slide forward?
Yep.
And we want to note that gold's position in the portfolio. As you recall, we moved to gold bullion last year, and that's been a good position and maintained in the portfolio, as I just mentioned. And gold is a good inflation risk. We like it in the portfolio. Clients seem to like having it in the portfolio. It's a good inflation risk, as liquidity needs could become much more prevalent in again this year with the sort of conflicts going on in the Mideast, with the shipping issues that are going on, and other issues could cause the Fed to start increasing liquidity again. And this could start inflation moving back up, in which case gold is a good thing to have in your portfolio. On the other hand, recession is also a potential risk. The longer interest rates stay high, or if interest rates become increasing, that could become a problem. We don't think it's as much of a potential risk right now. It's in an election year, but hey, conflicts and other things in the world could cause us to start seeing a recession problem. And then the currency risk, of course. Right now, the US dollar has been strong, but that can change in a heartbeat. And obviously, gold prices will increase in dollar terms, certainly, should the value of the dollar begin to slip or weaken. We think that the tech allocation, the healthcare allocations in the portfolio we also like those. And if the market continues to do well, as we kind of expect in 2024, then those allocations will help us as they did in the fourth quarter and last year. Moving forward, we can't help but point out our crypto block model and how well Bitcoin did. We don't want to ignore this. That's been in the news. That we've obviously received from the Federal Reserve their approval of actually of 11 spot Bitcoin ETFs. Anytime you have an asset class that goes up 155% in a year, you want to take a look at this. Our crypto block model. We've owned 50% in our crypto block model has been an allocation to Bitcoin through BITO, which is the ETF futures based Bitcoin portfolio. And we are in the process and have been analyzing in a very deep dive, taking a look at all of the options we have now in spot Bitcoin ETFs, and we'll be moving soon to a spot Bitcoin ETF from the futures Bitcoin ETF. Although BITO has very closely mirrored the ups and downs of Bitcoin, so we've been comfortable owning that. And but for cost reasons and other reasons, we will move to the spot Bitcoin ETF soon in our crypto block model. We'd also like to point out that actually our crypto block model has been around and active and invested since February 1st, 2020. What would that be? 2021, John? And so we'll be hitting our 3-year anniversary February 1st, 2024. So we'd be really excited to talk about that. We think that's something that should be in everybody's portfolio. But we just see that as an uncorrelated asset class that, although volatile, can add value to portfolios. So we'd be happy to talk about our crypto block model to any advisors that are interested. Other than those main points, I think I'll turn it over to John to go through some of our other information and our other model portfolio performance.
Yeah, thanks, Vern. So before I get to the performance of all of our model portfolios, I want to hit on some changes we made this quarter to our equity models. One of the key things we changed was in both the iSectors domestic equity allocation and the iSectors global equity allocation. We slightly reduced growth exposure in each model and increased value-based exposure that we mainly obtained through dividend-based ETFs. Now, growth has outperformed value for the last few years, but it's done so with much more volatility. In 2023, it outperformed as well, but this has led growth stocks to become, in our opinion, overvalued. You can see some of the current valuation metrics in the table here that we have. We show the Spider S&P Dividend ETF, which we use in the models as a proxy for value, the Vanguard Growth ETF, which is also used in both our domestic and global equity allocations. And then we also show the broad S&P 500 growth and S&P 500 value indices for additional context.
I'm still finishing.
Now, it may seem obvious that the value investments look preferable when comparing valuation metrics, but I think it provides a much clearer picture when you see these numbers side by side for value and growth compared to looking at them in isolation. For example, the price to earnings, the price you would pay as a multiple of earnings for the Vanguard Growth ETF is 29 times earnings. And for the S&P Dividend ETF is only 17 times earnings. For the growth index is 26 times earnings, and for values, 15. That's a pretty big difference between growth and value. The price to book for growth, 8 times earning, or 8 times the book value. And for the S&P Dividend ETF is only like 2.8 times the book value. So looking at the numbers like this, you can see just how, in our eyes, overpriced growth stocks are right now, which is one of the reasons we made this slight. We already had an overweight to value, but we increased that overweight a little bit more this quarter. We really made the change because we believe that value-based dividend-paying equities offer more opportunity going forward with less downside risk than growth stocks. So now that we talked about some of our more specific models in depth, let's shift to a look at how the broad markets fared in the final quarter of 2023, along with a snapshot of performance for the rest of the iSectors models as well. In general, 2023 ended positively for almost every asset class because of the Fed's dovish remarks about interest rates. Domestic and international stocks were up. Bonds had their first positive quarter since the first quarter of 2023. Commodities, however, unfortunately, they were the exception to the positive performance of asset classes in the fourth quarter. They had a negative 10.7% return in the fourth quarter, which was mainly driven by falling oil prices. This was actually the worst performing quarter for commodities since the first quarter of 2020. So it's been a while since commodities have had this rough of a quarter. They had been performing pretty well before then. This same trend mostly prevailed for the rest of the iSectors suite of models as well. Our broader inflation protection allocation underperformed the more focused precious metals allocation while we're on the topic of commodities, because inflation protection has a higher allocation to commodities, which includes oil, gold, silver, natural gas, things of that nature. But the precious metals allocation being only precious metals, gold, silver, platinum, palladium, outperformed inflation protection in the quarter, which just has some exposure to gold and silver, but not nearly as much as our precious metals allocation. And speaking of gold, as Vern mentioned earlier, our post-MPT, both growth and moderate models, have a 30% allocation to gold bullion. And that helped both those models outperform their respective benchmarks in the fourth quarter, which is the S&P 500 for post-MPT growth and a 60-40 stock bond blend for post-MPT moderate. Like Vern said, it's more fun to talk about positive performance. The last model I want to highlight is another one that Vern mentioned, the iSectors crypto block allocation. It had a great fourth quarter. Obviously, it also had a great full year of 2023 as well, which we showed with the returns of Bitcoin earlier. And having a 50% allocation to Bitcoin, this model will move mostly as Bitcoin moves. And we think Bitcoin, although volatile, especially recently, deserves a place in client portfolios as a low correlated asset class that has the ability to deliver persistent outperformance. And it's easily accessible thanks to the iSectors crypto block allocation and the launch of those spot Bitcoin ETFs this month that Vern mentioned earlier. A more in-depth discussion of each of these models can be found in the written commentary posted on our website, as well as fact sheets and model profiles for each of these portfolios individually if you'd like to take a deeper dive on anything. Well, folks, that's all we have for you today. As you carefully inspect this disclosure page, I want to thank Vern for his time. Do you have anything else you want to add, Vern, before we go?
No, that's about it. You know, while you were talking about the value versus growth, it reminded me back in graduate school when we discussed Benjamin Graham and his approach to investing in intrinsically undervalued securities. His definition that he talked about, he said that when you multiply price to book times PE ratio, value would be when those two multiplied together is less than 25. I mean, so if you take the whatever close to 30 times or 30 book values and 8 times PE ratios, whatever it was, or 8 times price to book and 29 PE ratios. There you go. Thanks.
Yeah.
That's a whole lot more than 25.
Way higher.
Yeah. So if we would think in terms of the old days when Graham and Dodd were looking at what's value, this probably got them turning over in their grave that anybody would buy stocks at these prices. So they truly are overvalued. And this is, we've always been a more value oriented type of investment firm. And it causes us some concern, which is why we've increased, as you said, that value allocation. So that's all. Thank you.
Yeah. No problem. Well, To end it, I'll show our contact page here. You can see contact information for myself and our Director of Business Development, Scott Jones. Don't hesitate to reach out if you'd like to schedule a meeting or ask any questions pertaining to the materials we presented today. Have a great day, everyone.